Hello everybody, welcome back to my channel, Trading Secrets. This channel is for entertainment purposes only, and for those of you who do not know, my name is Ali. I have over 20 years experience teaching accounting, economics, business and law. So through this channel, I normally like to provide you some stock analysis and also a short 5-minute trading lesson at the end. However, for today's video, I'm going to concentrate more on what's happening in the market, what's the situation, how can we do about it, what can we understand, and going forward and looking at the future, what is the most likely outcome. So tomorrow I have a very special stock that I'm going to bring you. I'm very bullish about it. It is a stock that I invested in on Friday, and I see potential excellent returns for this stock. So going forward, this is a stock that I'm going to be very positive about, probably hold it in the medium to the long term with a view of cashing out profits along the way. So please come back and watch tomorrow's video for special stock analysis of the new stock that I purchased on Friday. So let's start with today's video. Okay, so in terms of the last 2 weeks of trading, I'm sure we can all agree that it's been very difficult. There have been lots of gains that we achieved prior to the 2 weeks that have been lost. Before the last 2 weeks kind of trading, the stocks were doing very well. It was a very bullish market, and generally there was a positive feeling that this was going to carry on. However, what I would like to look at in today's lesson, in today's video, is understanding what has been happening by looking at market corrections. So before we do that, I think what we have to do is kind of sit back and try and look at the positive side of things. I know that might sound difficult, so sometimes by looking at the positive side of things, you have to just kind of smile, kind of, just stop thinking about what's happening. So let me draw your attention to this light-hearted picture here. So this is just a kind of a little bit of light-hearted humor. So let's have a look at this picture. So 2 weeks ago, many of you felt like the picture on the left. Right now, today, we are feeling like the person on the right. So how do we see the positive side of this? So a lot of you are probably thinking, well, there is no positive side of this. So, it's not that simple. However, you have to look at the positive side of everything. One positive side is I do expect the market to recover. I do expect the gains to come back. It's going to take time. It's going to require patience. But looking at this, let's look at the person on the left. He's not smiling. The person on the right, he is smiling. The person on the left, Mr. Floyd Mayweather, he's got no hair. Person on the right, he has got hair. So there's always something positive, and there's always something negative as well. So let's have a look at one more kind of comedy situation, and this is how we have all been feeling, I'm sure. In terms of your car, let's just hypothetically look at this car in terms of, what's the instruction? Is the instruction, do you go forwards or do you go backwards? And this is how we have been feeling on the stock market right now, and even the experts, are probably thinking, do we buy or do we sell? So looking at this example in the picture, if you buy, it could be a big mistake. If you sell, it could be a big mistake. So what's the answer? So the answer really is to hold. I think certainly if the stocks that you believe in, the stocks that you're holding, stocks that you have, you believe in the companies, the answer in most cases would be to hold. If the situation is specific to a company where you think the news is extremely bad, then obviously in individual circumstances it is a good idea to sell. So there has been the odd occasion where that has happened on myself, and I have cashed out at a significant loss in some shares, but in the vast majority of cases, we look at this picture, do you buy, do you sell? The answer is you do neither, you hold. So in this situation, you don't go forward, you don't go backwards, you wait for assistance, and you just keep calm and stay. So let's move on to today's main part of today's video. Okay, so the purpose of today's video is first of all to reassure everybody that at this moment in time, I think we can all agree that this is not a market crash. So there was a market crash in March 2020. So if we look at what happened in March 2020, lots of stocks fell well in excess of 25%. Lots of stocks fell well in excess of 50%. And even the so-called safe stocks had a huge decline. So that includes Tesla, that included Amazon, that included, Walmart, Microsoft. However, what we all are aware of is the vast majority of those stocks made a full recovery, with the exception of, let's say, airline stocks, the hotel industry, and the entertainment industry. However, the recovery for those, I also believe, is on the way. We did see recently with the stock of Airbnb, previous day's trading, Airbnb made a fantastic movement upwards in terms of positive outlook for the summer holidays and the bookings. So we're having a similar situation with airline stocks right now. I see the similar situation happening with the hotel stocks and also with the entertainment industry. So fingers crossed, the general movement upwards is going to continue now. So let's have a look at what we're going to look at. So obviously what I'm saying now is that it's not a stock market crash. It is a market correction. So let's have a look at what is a market correction. So the anatomy of a market correction. Let's look at this. So as I said shortly, 2 weeks ago, we were all very happy on the whole. Stocks were doing very well. The market was generally considered to be a bull market. However, what's happened in the last kind of 10 days, we can see that bull markets, obviously, as we've seen, are fairly straightforward, rarely straightforward, and it's common to experience turbulence. So within each bull market, stocks will go down for a short period of time. So the key thing I want to draw your attention there is the term short period of time. So that's the key to give you a little bit of reassurance. And let's move on and say what is this short duration. So the short duration in within this short duration, we have declines maybe of 10%, possibly up to 20%, and these are called market corrections. So this is what we have basically been seeing in terms of what has been happening with most of the stocks. We saw that Tesla at one point went down from well in excess of $800 to around about $650-ish, and there was an instant recovery. So I do expect stocks like Tesla to go back up well in excess of $800. But in this market correction where you have a decline of 10%, 20%-ish, that is normally a temporary phase. So that's the first thing in terms of reassurances. A stock market correction is normal. So why do corrections happen? So let's have a look at the next image here. Why do corrections happen? Corrections can happen for a number of reasons, and sometimes they happen for no reason whatsoever. So it's very difficult. So the reason why the stock market is difficult for investing for most people is because nobody knows the future. Not the experts, not the analysts, not the insiders, and not the institutional investors. So if you can get the most perfect analyst, the highest rating in terms of success he will have will be kind of around about 84-85%. So 84-85% of your kind of predictions, shall we say, are going to be correct. So in terms of a person I know, one person I know, she knows nothing about trading. She knows nothing about investing. But what she did is she looked at the stock that I'm sure you're all aware of, which is called HCMC, and she says, "Oh, that's cheap. It's 0.0001 pence. I think I'm going to stick £100 in there." And most of the serious investors, kind of ignored this stock, did not invest in this stock. I myself, I quite freely admit I did not invest in HCMC when it was 0.0001. It was more, at that time, it was more seen as a comedy stock. In hindsight, obviously that's a mistake, but everybody does not have the benefit of hindsight. So she, by investing £100 when it reached its peak, this is a person I know very well, I saw that she had a return well in excess of £5,000. So that just goes to show in the stock market you can also have extremely good luck. So it's not a perfect science. It's not something that we can say this plus this equals this and this is what will happen. So let's move on to the next slide. So the next slide is what to expect. So what to expect in a market correction. So we can see here market corrections are inevitable. They're part of owning stocks. They can make us as investors feel very, very nervous, and I'm sure that's been common over the last few days. So what is an average? What does an average correction look like? So the frequency is normally at least once a year. So I think this is our minimum correction that is happening for this year. That is happening right now. So we have reached our minimum one correction for this year. The length is, in based on previous years, it can sometimes spread out over 71 days. Now, what that indicates is that it may take a little bit more time for us to get to a completely full, good bullish market. However, in my personal opinion, I think this particular correction is not going to be for the average of 71 days. I think the maximum we're looking at, in my personal opinion right now, is a maximum 10 more days. Possibly even less. And fingers crossed, hopefully within the next week or two, we could see us getting out of this correction and generally recovering most of our returns that we previously had. So the average is 71 days. In my personal opinion, it's going to be much, much lower than this. But with the stock market being the stock market, nobody knows the future. The depth, so as we've seen, it's normally 15%, 20% on average. It's around about 15.6% based on previous corrections in the past. So what's the impact? The impact is we have uncertainty, we have volatility, and we have lots of alarmism. So that's certainly what's been happening. So moving on. So individual corrections can vary significantly from the average. So all corrections are not the same. This particular correction that we are experiencing is kind of based on the after effects of the pandemic. We've got the overvaluation of the EV sector and the clean energy sector. We have a change in government, so things are kind of moving there. We have a very dynamic and changing world environment. So the reasons for a correction can be scary and can be unknown, but it's something that happens, and sometimes we can see some stocks will go down in excess of 20%. So let's move on. In other words, in recent history, about 14% of corrections were the start of a prolonged downturn, but most are just blips on the radar. So based on statistics, we have an 86% chance that this is not going to lead to a crash and not going to lead to a significant downturn. So there's kind of, the odds are in our favor that this is not going to lead to a significant downturn, and this is just a blip. So that's the other thing to be reassured about. And in terms of the next slide here, let's have a look at what it says. It says time in the market. Is it worth trying to time the dips in the first place? So yes, we as investors, we do try to advise to buy the dips. We do kind of say, you should never buy when the price is high. So that's also important. But in the long term, it doesn't make a significant amount of difference if you are kind of holding the stocks for the long term. So research shows that timing may be less important than you think, and that is because of the long-term growth of the share. So let's have a look at that as an example. So if we go back in time to probably where some of you were not even born, and that is 1977. So from 1977, let's use an example of over 40 years, somebody investing at that time, three brothers and sisters. So we've got Jack, John, and Jane. So Jane is the person who times the market perfectly. Jack invests on the first day of each year, and John has the worst timing and invests at the when the price is at the highest, and that's typical John. Sorry. So what happens next? So in terms of what happens next, let's look at the outcome of that. Let me just try and find the slide. Okay. Okay, so the outcome of that here is the cumulative value of the, let's say if they all invested $10,000 each. Here you can see on the screen there that Jane, who has perfect timing, would on average get a 9.3% return. Jack, who has no timing, is just random, in terms of not particular timing. Sometimes it could be good, sometimes it could be bad. His return on average would have been 9.1%, and John, who has the worst possible timing, is 8.8% return. So the worst possible timing still gives you the benefit of excellent growth going forward long term. So the reason why this is excellent growth is compared to what you would get in a bank would be much less. So it's probably double or triple the return you're going to get by putting it in a high interest savings account. Okay, so let's look at finishing off this session now. Okay, so in terms of just finishing off the session, we're going to look at a summary of what we've just looked at. So the average market correction looks like, for example, we can have at least one correction a year. So we've seen that. So this is maybe our one that we're going to have for this year. So the good news is going forward, hopefully, there's going to be much better outcome for the rest of the year, and I'm expecting a much more strong bullish run. The length, as we've seen, it's on average corrections can be up to 71.6 days based on previous stock markets. However, I in my personal opinion, I think this will be a lot less. The average correction can involve a 15.6% decline, and we have seen that with many of the stocks that we've been looking at. Some have been up to 20% decline as well. However, remember, this is not a downturn and it's not a market crash. And the impact, obviously, we've seen that there is uncertainty, there is volatility, and there is an alarmism. So that's the overall summary. So in terms of reassurance, the market will recover. You just need to hold on to your shares in terms of especially for the companies that you fully and completely believe in. If you do have cash on the side to invest in, the bonus is this is the best time to invest. So the people who make maximum returns are in times like this. So it's more difficult for people who have all their money already tied up in shares, because obviously they have to wait for the money to recover and get their expected returns back. However, it's excellent news for somebody just starting out trading. So hopefully that helps. Please join me again tomorrow in the next video, where I'm going to do a stock analysis for a new stock that I invested in, and this one will be something I think will have an excellent future. Thanks very much, and stay tuned.